Hello, everyone, from Carlsbad, California. I am Al Mora, host of the Get MorAlpha show. About 1 minute late today, but that's okay. I'm not on anyone's time clock. I don't work for some major network. How oh, though I could. Is that the expression? If I only could. Um, if you've seen other shows and have come back for more torture and pain, well, thank you very much. If you haven't seen any shows, then you'll wonder what I'm doing right now. What I'm doing is tapping on the link that I put in Facebook for people to watch this show to make sure the link is working and make sure that I can monitor myself and that what you're seeing is what I want you to see. And so far, so good. I'm going to get out, though. I'm going to rename this chapter. It's not right. It's not named right. I'm getting out and come right. Hello, everyone. This is Al Mora, the host of the Get MorAlpha show, streaming live from Carlsbad, California. And if you're coming back for more torture and pain because you've seen other episodes, well, thank you very much for coming back. That suggests you found it at least worth your while to watch me and maybe throw darts at the computer screen and make fun of me and point out every little flaw in my presentation from the ties I've worn. I'm no tie today. To the way I present. Now, what I do at the beginning of each show is I hit, at this very moment when the show is starting, I hit the link that I put on Facebook so that you could watch the show to make sure the link is working. And I use this. There it is. It's working. Wow, it's really working great. All right. So this looks great. This is even quicker than usual. Put that on full screen and we're great. Okay. So we have a great show today. It's about hedge funds. Last week was supposed to be about hedge funds, and then I postponed the hedge fund show and did a review show that went haywire. The technology failed on me. I don't know why my streaming didn't work because I'm not even wireless. I'm Ethernet wired into the system to the internet, and never figured out why the connection didn't work very well. It doesn't matter. So that show was really just a review anyway. So I dropped that, wiped that show, took it out. And I've created what I'm calling Hedge Funds Part 1 because in the last 2 or 3 weeks, I've read a book about hedge funds. I'll talk about the book in the show. And I have continued just learning so much more about what's been happening with hedge funds since I took a close look at this. And many of you who watch this show know that I'm retired. I was very in the markets until 2012 when I retired. And since then, I have not paid attention to markets. I have not been reading my Wall Street Journal every day. And now I've begun doing all that again since I've started up this show. And so when I got back into hedge funds, wow, the universe had really, really changed. And it continues to change. And there's this narrative, there's a story that's going on that now I will get into with the presentation. So let's get into that. Let's go full screen. And sometimes it's blinky. There it goes. I think we're there. And I'll keep an eye on the monitor, and I think we are going to be in great shape. We're going to be full screen very soon here. So before starting, let's see if we've got it here. Doesn't look good, but maybe it will. Before starting, I am not a broker, investment advisor, financial planner, investment manager, hedge fund, or investment bank. I do not make explicit investment recommendations. Please consult with an investment professional before you make any investment decisions. I do think that by watching this show, you'll become a more skillful, knowledgeable investor. I don't think there's any doubt about that. And I include anybody at any level of investing, other than maybe these persons who I will talk about today who run hedge funds and these persons who've designed dark pools, etc. I think that what I bring is a lot of great fundamental stuff, and it's also, what would be the word, topical stuff that's going on and stuff that's really important going on in markets. Now, Hedge Funds Part 1, first thing I will point out is, notice on your left, so that's right around here if I'm pointing right, the title of a book. This is a title of a book that you can buy on Amazon called More Money Than God. It's about hedge funds. And I have a list of books, just 4 books later on that I recommend, but this is the first one I recommend because it really starts off with how hedge funds started, and they started very simply. So it's a great primer for learning about hedge funds because it explains how they started in the simplest possible terms. Again, because why? Because originally the first hedge fund wasn't even called a hedge fund. The person who formed it called it a hedged fund. And over time, this person never knew it, but others who pursued the same kind of approach to to investing, ended up calling themselves and being called hedge funds generally. People dropped the D and it became hedge funds. So there's a little history that comes from that book and plenty more. Sebastian Mallaby was the author of More Money Than God. Notice the subtitle, Hedge Funds and the Making of a New Elite. Good subtitle. But Sebastian Mallaby is, I don't know if he still does it, but he was, when this book got printed, which was in 2010, I think, he was a writer for the Wall Street Journal. And I believe one more book today that we're going to point out is of another person who's a writer for the Wall Street Journal who took time off to write a book about him. And I think the same thing happened to both of them. In each case, they wrote a very big story on the topic. And because they had done so much research for weeks, maybe months with someone else at the newspaper, they decided to go ahead and continue with the research because it was an important enough topic. It got enough headlines for a long enough time that it was worth a full-fledged book. Okay, so today, here are the questions that we will answer. What the heck is a hedge fund? What is hedging? Do hedge funds hedge? Are hedge funds criminal or meritorious? And this set of questions, by the way, mirrors those that I put up for investment banks, foreign investment banks, 2 weeks ago. I'm going to say 4 more rather than fur because I've been watching these videos and I have the Midwest Chicago habit of saying fur rather than for. Anyway, what do hedge funds produce? How much are hedge fund fees? Good thing to know if you're going to invest in a hedge fund. Are hedge funds really that successful? We will see. Are hedge funds a waste of talent? That's a really interesting question. What is hedge fund culture like? How much do hedge fund managers earn? Are you curious? I am. Should we bail out hedge funds if we have another crisis where we're bailing people out like the one we're in now? If hedge funds have problems, should we bail them out? The screen is looking great. Should your child be a hedge fund manager? That is a great question. So I'll tell a quick story. I told this one during the investment bank show. This is a Johnny Carson story. Johnny Carson had just been gotten divorced, and he was feeling the sting, and he did a show, came on his normal show. It was in the newspapers that he had been divorced. I don't know if the quantity that he paid his lawyers and his ex-wife was in the papers. Now we know that it was in the range of $10, $15 million. Well, this is in the 80s, I think. This is a lot of money at that time. And he goes, he says, okay, raise your hand if you think lawyers are just thieves, overpaid thieves, scoundrels. And everyone in the whole audience laughs, and they put up their hand. He says, hold them high. He says, now, hold those hands right there if you would donate that whole arm for your child to become a lawyer. And everyone laughs, and everyone keeps their arm up. So should your child be a hedge fund manager? I do have an answer to that at the end here, but it always depends. It depends on your child, and it depends on you and your philosophy and how it might differ from my philosophy. So there's something to think about and look forward to toward the end of the show, today's show. Okay, so we're gonna see some hedge fund history, and we'll have most of this in part 1 today, but some of this stuff that I'm going to show right now on this list will be in part 2 next Monday. All right, so we will look at hedge fund history today, and in more detail next week. We're going to look at some major hedge fund strategies. Not much today. That'll be much more for next week. A tiny bit of that, but not much. High frequency trading, much more about that today than next week. Dark pools, what is a dark pool, right? And I may turn you on to some websites and some books. I don't think I did much on the line of websites. I do have something for books. So let's take that website credit out of there. We'll do that in the next show. I really didn't end up doing that today. Okay. So there you get to see, and I enjoy doing this, you get to see how these presentations are actually created. You get to watch me edit. Okay, so there we go, and books, and plenty more. So what is a fund? Now, let's be careful. I'm not asking what is a hedge fund yet. I'm just asking what is a fund or a pool. No, let's forget about the word pool. Here's the definition of a fund for right now. It's a pool of invested money. Now, we're going to use the word pool in a different context very soon here, okay? And I will clarify what I mean by this pool and the other kind of pool. But yes, a fund is a pool, a collection of invested money, right? There is a large variety of types of funds. The ones that we will mostly think about and discuss in this show, today's episode, and in general in this show and other episodes, are the following: mutual funds. Mutual funds do this. They issue shares, their own shares, so you can invest in the mutual fund. What they'll do is they'll buy a bunch of different stocks and bonds, and they'll pursue some investing goal. And they will, before they go public, before they issue their shares, they will loudly and widely announce that the fund has been designed, that it has a strategy, and what its goals will be. So they'll sell these shares, and then what they'll do is use those shares to buy stocks and bonds, and they charge 1.5% of whatever you invest. You pay them to do all this work, right? Now we have exchange traded funds. They do the whole thing. They do the same thing, except they don't charge you anything. And these are more modern, and they are probably better than mutual funds for reasons that I've discussed in earlier shows. No time today, not the right time to discuss the other differences, but the two important differences are this: exchange traded funds don't charge that fee, the load. It's called the load for mutual funds. And another important thing is exchange traded funds get traded all day on exchanges, whereas mutual funds are not exchange traded. Mutual funds, you buy and sell directly from the mutual fund, from the company, and you buy them at a price that is set once a day. And that price is based on the value of all these shares and stocks, of shares of stocks and bonds that are in the fund at any given time. So if they go up in value, the fund goes up in value. And so your fund shares that you bought go up in value. But that price that your fund share has is set every day, every business day for the whole day. There are private equity funds, and what they do is they flip companies. We won't talk any more about those today, but if you've heard of private equity funds, there it is. Just like people flip houses, private equity funds will buy a public company and maybe just take it private, borrow a lot of money, and then just make it a lot more efficient. And what happens is, look, they're on the outside. They come in, and they don't know the people almost at all that run the place, and they have the comfort of being able to go and just really trim fat is mostly what they do. And they make companies more efficient, and then they take them public again or just sell them. Okay. Rarely do they just keep running them for the long term. Whoa, I think my window's open. I hear some noise. Close that window. It is. Let's get rid of the noise. That was not a good sound. It was a motorcycle. Okay, retirement funds invest in stocks and bonds. They don't do anything we call shorting, and they don't buy derivatives, and we'll get into those. We'll explain what those are. But a retirement fund, imagine the fund that your company keeps, that you invest in if you're working somewhere where they take a little bit of money out of your check every week. An endowment fund receives endowments, and then they hire investment managers, including hedge funds. Now, endowment funds typically are for universities and other similar kinds of organizations, and these funds can be massive. Hedge funds receive cash from accredited investors and invest in anything, and that's what we'll get into soon, very, very soon. Alternative exchange traded funds, they serve non-accredited investors. So accredited investors, in short, so let's go back to hedge funds, they're wealthy. Hedge funds receive cash from accredited investors, and they pool that money, and they invest in anything and do anything they want to do, any kind of derivative, any kind of strategy they wish. Why? Because they're serving wealthier investors, and the law gives them way more leeway as to what they can do. Alternative exchange traded funds serve non-accredited investors, but they basically act like a hedge fund. And they charge zero, which is in red. So again, exchange traded funds and alternative exchange traded funds charge zero. So they are the thing of today and of the future. They're younger than hedge funds, than mutual funds. They've been around for a while, but they're still not dominant. Here we go. What's a hedge fund? Here's what Investopedia says. I'm going to read. They are alternative investments using pooled funds. They employ different strategies to earn active return, or alpha. Alpha meaning more than the average investor would earn taking the same amount of risk. That's alpha. Okay. Hedge funds may be aggressively managed or make use of derivatives. They can use leverage, meaning they can borrow money too, and then go out there and invest in things that are really risky for all of us who don't know them well. But for they who know them well, they're not risky. It's like fire. They know what they're doing. But anyway, they invest in domestic markets, international markets, and they want to generate high returns, whether the market goes up or down. And it's important to note they are not accessible they are only accessible to accredited investors. Okay, so this mirrors what I just said. One aspect that has set the hedge fund industry apart is that they face less regulation. So there you go. And here we go. Each hedge fund is constructed to take advantage of identifiable market opportunities that they think they identify. They don't always succeed, but they often succeed. They use strategies and they use styles. Okay. Going to the next paragraph, legally they are private investment limited partnerships. So that means when you invest in them, you're a limited partner and you can never lose more than the amount you first invested. That's it. Okay. If they take on more liability than that, they will have to pay, not you. They're illiquid. This is great that they pointed this out because I didn't point this out. When you enter into a hedge fund, you can't sell your position, your part of the hedge fund that you own in any hedge fund that I know of. So it's illiquid. You can only get out of the hedge fund by getting your cashing out. Okay. Now, it's a private limited partnership. It's a pool of money raised from accredited investors. They avoid regulation. They use an exemption called Regulation D. There's some repetitiveness here, but it's so that we can learn. Okay, repetition breeds learning. Non-regulation enables the use of more tools. Here we go. Shorting. We'll get into this. We'll explain this. Derivatives, futures, and options are calls and puts. Okay, so derivatives include futures and options include two kinds. There are two kinds, calls and puts. There are all kinds of other combinations of options. You may have heard of swaptions and other TIONs, but they all are essentially combinations of calls and puts. They employ world-class talent. That's what the hedge funds do. Extremely aggressive. They don't really have a legal definition, and careful then, because you'll meet people who will say they are a hedge fund, and it's one person sitting in their cave, and they call themselves a hedge fund because it may sound prestigious. And they might be amazingly talented, and they may be earning millions of dollars, or they might be somebody who's going to crash and burn in 1 week. All right, so there are thousands, literally, not hundreds, thousands of self-defined and some very dubious hedge funds. And unfortunately, there are hedge fund indexes that contain what I think many people consider dubious funds. And also, some of the top funds don't participate. They're not part of indexes because I think you have to actually agree to be in an index to get in it. And these companies, especially a company called Hedge Fund Research, creates indexes, and I'll really get into them next week. I don't get into them at all today, other than this. To say that I saw a video of someone who runs a hedge fund, two men running a hedge fund, who both discussed the fact that one of them does not even put his data up, does not give access to his data for his hedge fund to Hedge Fund Research, and I think they're the top hedge fund website, hfr.com or .org. Anyway, so these indexes, having dubious funds and indexes, and the secrecy in hedge funds does make it hard to learn a lot about hedge funds. That's part of what's taking me more time to get into these presentations. It takes a lot of work. So what's an accredited investor? All right, let me remind you that stocks crashed in 1929, and in 1933, the Securities Act of 1933 became the first and most important U.S. securities law. Its purpose was to protect investors from fraudulent securities, and it had two methods. Mainly, it required that everybody who's going to issue a stock register a stock or a bond, any publicly traded security, and it requires companies to report their financial results publicly, okay? And it also requires them, I didn't put this in here, to follow generally accepted accounting rules, okay? The exemption is called Section D. It's within the rule, and it defines an accredited investor as, and right now that changed. Earlier they had a definition, and over time that's been amended, but the current definition of an accredited investor, okay, meaning someone who's exempt, who is exempt from registration, okay, either as an individual who earned $200,000 for 2 years, or a married couple, who have earned $300,000 combined for 2 years, or they have $1 million of net worth, excluding their primary residence. However, you could also be considered accredited investor is, for example, you're an experienced professional investor. You may run an investment bank, and for some odd reason you don't meet the other two rules, but hey, you're experienced, or you're a finance professor, etc. And who keeps track of this? Who makes sure that you're accredited before you get in there and get to invest? People who you sign up with when you get involved in investing, people through whom you buy the investments, police this. They're the first line of defense, because when you fill out forms to open accounts, they ask you about your income in order to decide what kind of investments they will allow you to buy. Okay. And by serving only accredited investors, hedge funds, again, this is repetitious. They don't register. They don't have to go out and say we're registering ourselves as something like a stock or anything. And we don't have to give up a lot of that information that's required. We don't have to give it up to the public. We can give it to whom we decide to give it to. Do hedge funds hedge? Well, let's see. Let's define hedging first. So let's say definition of hedging. Okay. We don't need that colon. So let's see here. Do hedge funds hedge? A hedge is any action taken, and I won't say or not taken, because that was something else I was writing, to lower risk. I was writing something different. I stole some language from that. Here we go. So any action taken, any position you take, anything you do to lower risk in this context of investing. You could, for example, short a stock you own before it falls. Okay? That's different from shorting a stock you don't own so you can make money if its value falls. Okay? So that's speculation. We're talking about hedging. And hedging is, in fact, the absolute, perfect, exact, diametric, polar opposite of speculation. Okay? You could sell a futures contract on a stock you own. If you sell a futures contract and the value of your stock goes down, the value of that futures contract will go down, and it'll protect you, one for one. You could buy a put option on a stock you own. That gives you the right to sell. A put option gives you the right to sell a stock. In this example, it would be a stock. A put option can give you the right to sell anything. But in this example, a put option is the right to sell a stock you own. And that way, if the value of the stock goes down from $100 to, say, $50, you can sell that stock at whatever price was on the put option. So if you buy a put option to sell a stock for $100, and it's worth $100 right now, you own it, and then the value of that stock goes down, you can use your put option to make the same amount that you lost on your stock. You make it back on your put option. And you can combine any of the above, and that's a way of hedging. What do hedge funds do? Do they hedge? They range from zero hedging to constant hedging, like by millisecond. And hedging strategies can change completely, gradually, or millisecond by millisecond. Okay, even in a millionth of a second, incredibly. Okay. So here's an illustration of hedging. Before we hedge, we have some position we're in. And every position has an upside and a downside. It has opportunity and risk. So example one says we're going to buy a currency, or we're going to sell a forward. Here we go. Our long position is we bought a currency. We have upside. We might make money if the currency increases in value. That's the green part. But we have risk. If the currency loses value, we're in the pink. And that blue bar says where we are. We start in the middle. And if the value of the currency goes down, then it goes to your left this way on that blue bar, and you go downward on that blue bar, right? And then if the value of the currency goes up, you go upward on that blue bar, and you make money. Up is good, green is good, red is bad. But then you could put on a hedge like selling a forward. And it turns out selling a forward, don't try to understand this more technically than this. Take it right at face value. Selling a forward is the exact opposite of owning the stock. If you sell a forward, if the stock value goes down, you'll make money because you'll buy that forward back more cheaply. And if the stock value goes up, you'll lose money because you'll have to buy that stock back more expensively. Don't try to understand it better than that. Just trust me that it's the opposite of owning the stock. It's a new contract that you enter into. So at this point, you've got two things you've done. You bought a stock and you own a contract. You are participating in a contract. Let me say that. You signed a contract that could have positive value that you own, or if it has negative value to you, that you owe. So it's a fascinating contract because it could become an asset or a liability to you. It could be something you own or owe moment by moment, depending on how the market is moving. That is an amazing, almost miraculous type of an instrument. But when you combine these two bars, one goes up as we go to the right, and the other one goes down as we go to the right. One goes up as we go to the left, the other one goes down as we go to the left. They neutralize each other. So you're neutralized. Okay. And another example would be you could buy a put. So your same long position, you buy a put, and you have an area where you would never lose money. You just lose a little bit of money. You're a little bit in the pink, in the red, because during part of it, because you paid for that. But that's the most you can lose. You paid for the put, and then you would only actually use the put. You would only actually exercise the put when the put goes in the money, when it pays off. And by you putting on the put, you end up keeping your gain. Notice your hedge position now compared with the guy on top. You can make some gain because you bought a put, and you can have some loss. So what have you really traded off? In the top one, you don't have loss or gain in your hedge position, but in the bottom one, you can have some gain and you can have some loss. So who does which? Okay, the person who has no clue which way the market is going to go, but really wants to take no risk does this. But the person who has a sense, a feeling, maybe even a high confidence that the market will go up, will say, I want to keep my gain, but I'm still worried the market will go down, so I'm going to buy this put. That's hedging. The shape of a hedged position depends on your initial position and your choice of hedge. Now look at this chart. You see all these lines are going to all go up. Ignore the words on the chart. And every one of those bars, the blue bars, are going to go up right now. Watch. They all go up. Okay? What am I teaching us here? Investment banks do the same thing. And so do, mainly investment banks. They do the same thing. They get into long positions. Believe it or not, these long positions could be that they own derivatives. But they have some kind of a long position. They sell it forward or they buy a put. And they end up in a better hedged position than the rest of us because when they trade, they are the market makers and they enjoy price advantages over the rest of us. So their position is better for them, and that's where they make a profit. A bank's individual and combined positions, now on the bottom here, are multidimensional zigzags. So this long position to begin with here, this guy, this is a simple straight line, but that could be a total zigzag that goes up, down, up, down, down, up. It can be very complex. So the kinds of hedges you turn on would be very complex as well. Those are called derivatives. Again, they're just combinations of calls and puts. Okay, mutual funds, ETFs, and hedge funds. That's who we're talking about today. We're really going to get into hedge funds, I promise. But we're preparing. Okay. Mutual funds, exchange-traded funds, and hedge funds. Mutual funds, exchange-traded funds, hedge funds, and alternative exchange-traded funds. Are they public or private? Are they regulated? What's their primary purpose? How smart are they? What kind of fees do they charge? Approach and trading tools. This is a side-by-side. So it's more redundancy, more repetitiveness to have another look at the same information. I believe in doing this because it enhances learning. Okay? So, a mutual fund issues publicly traded shares, and so does an exchange-traded fund, an ETF. Okay, a hedge fund is a private limited partnership, and when you give them your money, I don't think you own anything. I think you just own an account with them that has cash in it, and then when they buy investments, you own those investments through them, and they are your gatekeeper. They're your keeper. They're storing stuff for you, like your bank stores cash for you. That's all they're doing. Okay. Whereas an alternative exchange-traded fund does issue publicly traded shares, just like this guy, just like him. Exchange-traded funds and alternative exchange-traded funds, they issue shares. How highly regulated are mutual funds? Vary. Exchange-traded funds vary. Hedge funds, not very much, which gives them a lot of flexibility. And alternative exchange-traded funds are a new creature I'm learning about that must be less regulated than these guys because they have a lot more flexibility in what they can do because they trade like hedge funds. They do things that hedge funds do. What's the primary purpose of a mutual fund? Diverse long-term investment, safe investing, not day trading, not quick turnaround, not big-time speculation. Just build your kitty so that you can retire and not work. Okay. Exchange-traded funds could be long-term or more short-term because exchange traded funds trade throughout the day and the price changes. So it could be day to day. It could be a day trader investment. Hedge funds, their primary purpose is to make large returns in all market environments. That's what you want when you give them your money. All right. And then that's what's interesting about the primary purpose of an alternative exchange traded fund. They also want to make large returns in all market environments. So that's fascinating. Their IQ and skill is high for mutual funds. These are all professionals. Higher for exchange traded funds, I think. My impression so far. Highest for hedge funds and alternative exchange traded funds, higher than average. Fees 1% to 2% for mutual funds, none for exchange traded funds. All right, here's where hedge funds are expensive. They charge a 2% fee to manage your money, like investment managers do. And they also charge 20% of gain. So if you make a 10% gain, they get 20% of that 10% gain. They get 2% out of the whole portfolio, plus 20% of the gains. Okay. And what fees do the alternative exchange traded funds charge? None. What is a mutual funds approach? It's very fundamental. It's very academic. It's very traditional. It's good. Exchange traded funds as well, but they're not perfect. Hedge funds have been able to outtrade these guys. Not all. I'm talking about top hedge funds run by geniuses who we're going to meet in the coming slides. Okay. Alternative exchange traded funds use both, I think. I think they're in between fundamental plus dynamic and aggressive. Okay. And what are the trading tools of a mutual fund? Buy stocks and bonds. Exchange traded fund, buy stocks and bonds. But what does a hedge fund do? It shorts, well, it buys stocks and bonds, and it shorts. It buys and sells derivatives. It does high frequency trading. It does macro trading. We'll talk about that more in next week's show. It uses artificial intelligence. It trades based on news. It trades based on arbitrage. Alternative exchange traded funds do a lot of stuff too. Now, they don't do high frequency trading so far as I know. They don't do arbitrage so far as I know. But they use derivatives. They do macro trading. They may do some news trading. And they use artificial intelligence. What is this thing? We're going to see where hedge funds fit in a map I created that's in earlier shows. Here's the key. These arrows that you see follow this key. Blue is stocks. Red is government bonds. Government bonds. Mutual funds. ETFs and hedge funds are black. Currencies are green. Corporate bonds are orange. And derivatives are purple. And who are the entities? Here we go. Governments and government agencies, stock and bond and derivative exchanges. These are exchanges and pools. And we have mutual funds, ETFs, brokers, investment managers. So these are the boxes we're going to fill in. Individuals and companies, investment banks, and hedge funds. I've talked a lot about investment banks in prior shows. They're the guys who create stocks and bonds. They're the guys who take people public. They're the guys who run IPOs, initial public offerings. Okay, that's one of their huge roles that they play. It's the one unique role that they play. They do other things that others do, but the unique thing that investment banks do is create new securities. So if you want to know where securities are literally born, they are born in investment banks. So on one side of the world, we have issuers and currency sellers, and in the middle, we have intermediaries through whom these securities, assets, currencies flow. These are intermediaries. And on the other side, we have investors and people who buy currency. And we have U.S. companies, international companies, governments, central banks, municipals like states and cities and counties, the U.S. Treasury. Way over on the right, we have individuals as investors, hedge funds investing. And notice there's a black arrow running from the hedge fund to the individual. That's the hedge fund giving the individual its profits. We have investment banks who also invest. U.S. companies, international governments, some of the guys that are on the other side, international central banks, municipals like states and cities. All right, but there are some pieces left here. We have this Federal Reserve that literally issues our cash. Okay, we have them. They're important. And notice that they are involved in the red, bonds, government bonds. Red is government bonds. We have futures exchanges, stock and bond exchanges. We have U.S. retail banks, like the bank you put your deposits in. We have mutual funds and exchange traded funds. We have brokers. We have investment managers. Okay? We have them. But then the big role we have that I talked about a lot in the prior show, was that investment banks contain stock underwriters, bond underwriters, primary dealers that issue government securities, derivatives dealers, and currency dealers. All those are inside the investment bank. And notice it flows Everything flows through them. Okay. Now we have something new happening. You see this new stripe? Things are going right to individuals, right? They're going right to individuals. Instead of going through these intermediaries, they're not going through brokers, they're not going through investment managers, they're going right to individuals. See these? And what do we have? We have the orange, which are corporate bonds, the blue, which are stocks, the purple, which are derivatives, the red, which are government bonds. Those are flowing to individuals through online brokerage accounts. And that's why we have the red, purple, blue, and orange stripes that show how you can, by investing in online brokerage accounts, you can have access to all this stuff directly and bypass people and pay fewer fees and get better pricing. Here's a slide I've shown. It gives us context. Don't worry about all the dialogue underneath. It gives us context for what follows about hedge funds. That's what it's for. It's got a lot of other detail that we're not going to use. But what it shows is that green is profitability and red is risk, and it just compares different categories of investment. And it's a broad long-term analysis that I created several years ago. Contains many years of data in it. But let's look at the first item on the left, on your left, on this side. It's called treasury bonds. That's the safest thing. Because notice the red stripes are at risk. So it's the safest one because it's got the lowest red bar. Okay. That's the safest investment by U.S. Treasury bonds. But then if you could buy an index of global hedge funds, which you can now, then you would have average return of 6% and volatility. That's how much risky you are, of 11%. I will not explain volatility today. Later on, I've explained it in many shows. I'll explain it in future shows. Today, it suffices to say that this index is more risky than the safest, which is treasury bonds. And that's it. So now you've seen what a global hedge fund index is compared with treasury bonds. It makes about the same, but it's more risky. Not very impressive. Why? Because that index contains a lot of those really amateur-y, shaky, borderline global hedge funds. Okay. Now, let your eyes keep going to the right, to the right, to the right, to the right. Way on the right, you'll see McDonald's. All the way on the right. Okay, go left one. And you'll see top 100 hedge funds. And what a different story, okay? Because top 100 hedge funds make 14% during this period that I analyzed with 15% of risk. So way more return than treasury bonds, way more return than the global hedge fund index with not much more risk. So that says hedge funds did well during the period that was analyzed. Now they haven't. Since I did this, they haven't. Now, this extra information we'll ignore. But that would be the money you would make if you invested in a hedge fund, right there. This is other information about the fact that they make really more than that, and then they charge you fees, and that's what you're left with. Now, we're going to put hedge funds in the context of optimal portfolios. This is the capital asset pricing model and alpha. And optimal portfolios are portfolios that are created in theory following this model. And in this model, each dot represents an investment. The blue line represents the best stocks given the amount of risk you take. So return, the money you make goes up and down. The stocks are higher when you're going to make more. If you're expected to make more, dots are lower if you're going to make less. Dots are farther to your right. That way, they're farther to your right if they're more risky, and they're farther to your left if they're not risky at all. If they're less risky, and if they're not risky at all, they're all the way on the black stripe that's horizontal. Perpendicular. The efficient frontier is a frontier that just touches the edge of all these dots. If we filled it in with 4,000 dots, it would be full, and it would the top dots would touch the efficient frontier. Then there's this risk-free asset that's called treasury bonds, especially short-term treasury bonds. And there is a theoretical line. This red line is called the optimal portfolio, and it touches the efficient frontier right at a point that ends up being the market portfolio, meaning that would be what you would have if you bought a portfolio of the whole market. Okay, that would be the expected return and the risk level of a portfolio that contained the entire market. So you could either own the whole market, or you could own a small portion of the market that is divided in the same proportions as the whole market. So if the market has 1/2 of bonds and 1/2 of stocks, you would have 1/2 of bonds and 1/2 of stocks. If it has 1% of it is Facebook, you would have 1% of your portfolio would be Facebook. That's what it would mean to have the market portfolio. Okay? All right. So what is the relevance of all this? Okay. Well, two things. Efficient portfolios combine the market portfolio, the purple guy, with the risk-free rate, risk-free asset. Okay. And you can also even borrow money, but that we won't talk about today, and be on the red line. So if you're on the purple dot, you own only the market portfolio. If you're on the red line below the purple dot, you have bought bonds and you have bought stocks. If you're at the green dot, you only own bonds, treasury bonds. But going back up, if you go past the purple dot going up, now you've borrowed money and you own stocks and bonds. Okay. Here we go. In fact, you would not own bonds. You would only own stocks if you were above there, above purple. But here's what the hedge funds are trying to do. They're trying to be the orange line. Here's what they're doing. Then they're outperforming the optimal portfolio. And the difference between those two lines, that's alpha. Okay, so alpha is the difference in what you earn and what the market has earned. And if you have negative alpha, you've done more poorly in the market. So hedge funds use speed and artificial intelligence. I wrote API, but that should be, I'll just say it. Artificial intelligence. Here we go. That's it. In an attempt to earn alpha. Okay. There it is. Hedge funds use speed and artificial intelligence to attempt to outperform, to earn alpha. Here we go, some hedge fund history. Market history. Way back in the 1600s, from the 1600s to the 1930s, stock markets developed like the New York Stock Exchange and bond markets. There wasn't much regulation. They were controlled by few rural participants, especially at the center of the market. And there were wide buy-sell spreads, meaning to go in there, if you went into them, the people who ran the market, this is how they made money. You'd say, I'll buy a share of AT&T shares from you. They say, sure, $100. And then you turn around, I'll sell it right back to you. They say, sure, $90. Very widespread between $100 and $90. And that's hurting other investors. The guy in the market dominates the market that way. And then there was fraud. There was front running, meaning some people could say pay the guy who's controlling the market to let them have a better deal than the next person who comes along. There were fake stocks literally issued at the time that the stock market crashed. People would manipulate the market by making up rumors. And there was insider trading because investors would know ahead of time how companies were doing, and they would trade ahead of time before this information was released to the public, so they had an advantage. The stock market crashed in 1929, and so in the 30s, we had the NASDAQ appear because earlier it was just the New York Stock Exchange. We had better regulation, and stock exchanges did continue dominating, but then we had these business schools like where I went, started teaching management and finance theory, and corporations and the financial sector just exploded from the 30s to the 70s in size. You had a tiny industry with only a few hundred people in it, probably, to having tens of thousands of people in it. The whole finance industry, especially in Manhattan and New York. The earliest hedged funds combined investing with hedging. Okay. In the 70s through the 90s, financial theory and computers drove financial innovation and creation of derivatives. So trading became the primary investment banking profit source. So investment banks sold their souls to trading. Okay. And they had what they called proprietary trading desks. So then they had iBanks and hedge funds hiring PhDs, the smartest people in the world, to program computers. So lit pools and dark pools were created. This is electronic exchanges where high-speed computers could trade. Okay, so there was this demand that got created for high-speed trading, and the normal markets were slower than the computers. And so people created pools and got approval from the government that allowed someone who owns a stock to sell it to someone else without going through the exchange. And that really took an amazing amount of power from the exchange. And that big spread I told you about between $100 and $90 shrunk to 9, to 8, 7, 6, 5, 4, 3, 2, 1, 50 cents, a quarter, a nickel, a penny. It just shriveled away because now there was competition. So demand for fast markets drove the explosion in electronic lit and dark pools. Lit pools are pools where everyone can see what's going on. Dark pools, everything you do is anonymous. So you can go in there and participate anonymously. You don't know who bought the shares you sold, and they don't know who you are. And no one knows who anyone is. So that protects people from knowing what you're doing in the market. Okay? So traditional markets lost a lot of market share. High frequency trading really started automating, and it became not API, AI. I keep writing API. Artificial intelligence today. Okay. I forgot what API means. It means something about the internet. Okay. So in 2010, the Dodd-Frank Act. Let's do this. In 2010, the Dodd-Frank Act prohibited investment banks from proprietary trading. So that meant, hey, you can only trade and have inventory that your customers come and buy from you regularly. You can't just be churning, buying, selling for your own account. We will keep an eye on you when we have the ability to check every trade, which they do. Okay, but guess what? iBanks. Let's look at that last bullet point. You know what I should do? Let's do this. Make it red. Make it large. There we go. And now we're really getting the message across. But iBanks still own dark pools and pieces of high frequency trading shops, even though they're supposed to be completely out of that business. They're getting away with it. So who are the largest hedge funds right now? And who are the people who run them? Bridgewater Associates is run. It was founded by Ray Dalio. There's his photo. They manage $132 billion. These are in millions. 1,500 employees. It's in Westport, Connecticut. You're going to start seeing the locations here. This is neat. Renaissance Technology. And by the way, they manage $132 billion. I'm going to repeat that number. $132 billion. How big is that? Well, it's not that big in a way. Why? The whole market is $20 trillion. So as individuals, they only own $132 billion. And I think, in fact, the whole market's more like $30 trillion. And I think, I remember a number like 10%. Hedge funds combined, all owning about 10 to 15%. But yet they do 75, 80, 90% of the trading every day because they get in and out of everything. So they only own a portion, but they trade everything a lot. Anyway, Renaissance Technologies was formed by James Simons. He's some kind of a legend as well. They're in New York, in East Setauket, New York. I wonder if I said that correctly. The Man Group, 62 billion managed, 1,400 employees. Apparently, I don't know how many people are at Renaissance. Don't have that. Okay. Anyway, the founder was James Mann, but now someone named Luke Ellis, and you see his photo there. Luke Ellis runs it now. And they are in England, so this is a nice British firm. Maybe they still call it British White Shoe. I don't know. AQR Capital Management is run by Cliff Asness, who we're going to meet better in the following slides. And he's in Greenwich, Connecticut. Two Sigma Investments has 43 billion. John Overdeck runs it. He founded it. Millennium Management is run by Israel, was founded and is run by Israel Englander. You see his photo there. Elliott Management, he looks a lot like James Simons, doesn't he? Elliott Management is Paul Singer. Boy, three of these guys look a lot alike. BlackRock, Larry Fink. Citadel, Kenneth Griffin. Davidson Kempner Capital Management, Anthony Yoseloff. Okay. So these are the largest hedge funds right now. Here's Bridgewater's website. See, they're the biggest. So here's their website. They've got something you can stop and read later. You can pause here. And it's interesting stuff. How they describe themselves on their own website, and they describe what they do on their own website. Naturally, they describe themselves and hold themselves out as being very good corporate and community citizens, but I don't know. Based on what I'm learning more and more, I'm doubtful of that. All right, I'm skeptical of that. Okay. So now, there's a relationship between high-frequency traders and electronic pools. High-frequency traders benefit from speed, and they trade on electronic exchanges or pools. So the pools and HFTs have evolved hand in hand along with computers. Some geniuses who built pools are called plumbers, and they moved to high-frequency traders. So just knowing how the pools work is so valuable. Some of them have become HFTs, and they've made amazing amounts of money, billions of dollars, because they know the plumbing. So yeah, the plumbers teach HFTs how to exploit pool functioning. Pools compete for market share with O-liners like New York Stock Exchange, and they compete with each other to gain market share. Pools design very HFT-friendly platforms. Boy, do they ever. They go so far as to pay HFTs to trade. They'll pay them some fraction of a penny per trade. And some HFTs have gotten to the point, there's so many, they've clogged up the space so much. They battle each other so aggressively that the way they end up making money, some of them, is not by making any money on trading, but by being paid by the pool, because the pool will pay them to trade, because the pool makes fees. The pool makes even more fees from other investors, from the less powerful investors. So the pool gets a little fee from them, part of which it goes to paying the high-frequency traders to trade. So that means the high-frequency traders are giving you what's called liquidity. It's giving your investors the ability to sell something quickly and at a pretty darn good price without having to think about it too much. Okay, definition: a high-frequency trader or high-frequency trading is the use of computers to place a high number of buyer-sell orders in an electronic market. Notice, that's all you control. You control the kinds of orders and how many you put in. High-frequency trading computers place the orders as fast as every millionth of a second. High-frequency programs run on banks of leading-edge computers, right? Banks, not meaning the bank you put money into, but piles of leading-edge computers. HFTs hire the very best talent in the world. They hire computer programs, math programs, scientists, physicists, people like that. Now, but these people are curing, who could be curing cancer instead of being top talent at an investment bank, could be curing cancer, saving planet Earth, or they could be president. Wouldn't that be great? So now I'm going to go through the differences between lit pools and dark pools and what they are. So they're both electronic exchanges. Some of this is repetition. Computer power inevitably drove the evolution of exchanges to dominance of electronic exchanges. There we go. Okay. That was inevitable. It was going to happen, and it happened. In lit pools, everyone sees what everyone's doing. In dark pools, things are done anonymously. Initially, dark pools protected mutual funds, serving moms and pops, but they no longer do. It's just changed. Pools, they're still very, very large, and it's worth your trouble if you have a significant portfolio, and if it's not, it's worth it to learn. Back up in dark pools, orders are filled anonymously, and initially dark pools protected mutual funds, serving moms and pops, but they no longer do. I'm getting a little tired. That showed there. It's okay. Forgive me. Pools operate independently of the old line exchanges, which I pointed out earlier. The intent of pools originally was to reduce the old line monopoly, but now the pools are an oligopoly. It's a small group, not that small. There are probably about 100 pools around the world, 70 major ones and smaller ones, 75 major ones. The old liners fought hard. They did not want the pools to come into existence, but now, like I say, they really dominate, and pools enable ever faster high-frequency trading. Then there's going to be a point where they can't accommodate it, because you have one computer processing orders by many computers, and there are millions of orders. So the computer gets overwhelmed. And that has happened. That has overwhelmed the market at times. Okay, so pools support an amazing variety of order types, and some even give an unfair advantage to certain participants who just pay for it. That's not right, but it's done. Can you believe it? The government doesn't stop it. So that's a problem. I don't like use the word problem almost at all, but that's an opportunity for improvement. So can you believe that? Pools pay market makers, people who participate, to participate. So what's going on with proliferation of pools then? There's so many dark pools now. They're going to drive their fees down that they charge so low that they're going to start going out of business. That's the pools side. And as they get a larger share of the market, hedge funds won't be able to outperform the market, because in the extreme case, for example, that you are the whole market, you own all the shares, you can't beat the market because you can't beat yourself when you own all the shares. So the more of the market that you own, the less you can beat the market. And hedge funds and high frequency trade, hedge funds slash high frequency traders, hedge funds slash high frequency traders are there. Okay, they're having a hard time earning alpha. Now here's a list of dark pools just to get a feel for how much they proliferated. Excuse me, because we looked at a bunch of, and we're going to look at more hedge funds. But look at these dark pools, broker dealer owned dark pools. Wow, they should not own these pools. Consortium owning dark pools, exchange owned dark pools. None of these should be this way. These have a natural conflict of interest. They're places where people trade securities and they compete for that volume. That's how they make money. So you shouldn't have somebody who trades at the same time owning the exchange on which it trades, because they have an unfair advantage over everyone else on the outside. They can tweak it, and they can somehow trick the system to always give them the best trade of the day every day, rather than treat them when they invest in the exchange as though they were the average investment without unfair advantage. Here are independent dark pools. Good to see. The more of these we have, the better. And okay, we'll get into that. All right. Get a little tired thinking through. All right, so then next. Gosh, I got tired there. What is business? Business is taking risks to benefit society, and investing is taking risks to benefit society. But when you do front running, what you do is you see buy and sell orders. This is what high frequency traders do. They see buy and sell orders before other participants. And you can make money on almost every single trade with risk. And pools are allowed to sell front running to investors. So that's what these high frequency traders do. They pay the pools, and then they threaten the pools. They say, I'll go to the other pool if you charge me that much. So the pools lower the price, so the pools have a struggle. They want to charge more to make more money, but they charge the least they can get away with and make money so they can attract investors and get more volume. Tough trade, tough business now. Spoofing is placing a giant fake order. You move the market, and then when the market moves in the direction created by just placing the order, you pull the order. For example, let's say you want to sell. You pretend like you want to, let's say you want to buy. You want the price of something to go down, okay? You really want to buy. You'll put a big sell order up, and right before people fill it, you take it down, and people think, oh, there's a big sell order in the market. Sell, sell, sell. They drive the price down, and now you buy. You're sitting there behind the bushes waiting because you put out a spoof order to move the market in your favor. Guess what? Some days more than 90% of high-frequency trading orders are spoofs. They get pulled. Unbelievable. And it's legal. So front-running and spoofing hurt mutual funds and ETFs serving mom and pop. Because all this extra money they're making, when they pay less for something, it's who are they paying less to? It's the mutual funds and the exchange-traded funds, meaning mom and pop, because that's what they serve. Now, they do this stuff. Hey, high-frequency traders do this stuff all day, 24/7, to battle each other. They don't even care about you and me, who have small portfolios. They're all fighting each other with these large portfolios. They have billions of dollars. Okay? In artificial intelligence, what's with the AP today? Artificial intelligence programs. Okay? They gather numerical data, like, say, economic statistics and earnings, and they read the news, right? And AI programs are tested before going live. And again, they've been so aggressive toward each other, they've whittled away profits. So they're tested. The AI program is tested before going live. They're so aggressive, They have whittled away profits. Okay. High frequency wars probably caused the $1 trillion flash crash of May 6th, 2010. Now the market came back, and $1 trillion was lost in about a half an hour. Then the market came back by the end of the day. Nevertheless, no one ever figured out the crash. The flash crash remains unexplained, and there could be others. Because these high frequency programs they create, they're trading at millions of trades a second. So if you have one bad second where things go poorly, you can destroy the wealth that you've accumulated through an entire lifetime. Okay. High frequency trading origins, it was first practiced by investment banks, proprietary trading desks, they call prop desks, and investment bankers who got good at it left the prop desk and they formed independent hedge funds, high frequency trading funds. Here's a case study. Cliff Asness. Cliff Asness went to the University of Pennsylvania and then to Wharton. In 94, he got a PhD from University of Chicago. I received my MBA from University of Chicago in 1993. That means Mr. Cliff Asness and I were at University of Chicago at the same time. For all I know, I've sat at a table and had lunch across from him. The cafeteria is there. He was the assistant to a Nobel laureate at University of Chicago, Eugene Fama, yet another one. And then he went to Goldman Sachs Asset Management in 1990. That was before he got his PhD notice. In 95, within Goldman, he created the first high-frequency trading shop called the Goldman Sachs Global Alpha. Here we go back to the word alpha all the time, over and over again. And then he formed AQR, which probably stands for Alpha Quantitative Research, something like that. And he went independent. He left Goldman in 1999. Okay. All right, that's it. So that's an example of somebody who started a high-frequency trading operation. Okay, he was an iBanker, then he formed his own. Okay, now in 2019, let's look at some just recent data. The hedge funds underperformed the market in 2019 because it had a big year. It rallied. Top 15 hedge fund managers nevertheless made $12 billion combined. 5 of them earned over $1 billion. Okay, who were the 5? Chase Coleman from Tiger Global Management. His fund made 33%, so he made $1.1 billion. He's number 5. So it gets better from here. Look how young he looks. Steve Cohen, who's been around for a while, has a company that got in a lot of trouble they were called something else before. Oh, I wish I could remember. And then now they're called Point72 Asset Management. And they made 16% last year, and he made $1.26 billion. Ken Griffin, he runs Citadel, and they made 19%, and he made $1.5 billion. So, for example, Steve Cohen could argue that, hey, no, I guess he can't argue that he should make the same as Ken Griffin because his firm made less than Ken Griffin. But notice Chase Coleman, he could argue he deserves more than both of these guys because his main fund made 33%. All right. Jim Simons made 1.7, and his return on his fund was only 14%. He has a lot more influence, clearly, in his company. Chris Hahn had a fund that made 41%, and he made $1.8 billion. He was the top in the world. I happen to have put together one that has the top 25 earning hedge fund managers back in 2013. And it's interesting because George Soros, look at the top left, earned $4 billion in 2013. This was reported by Forbes in 2014. Steve Cohen was in trouble. They were found guilty of insider trading, 8 of his traders, and they went to jail. They paid a $1.2 billion fine, and they no longer could accept other investors' money. They gave all the money back that investors had put in them. So Steve Cohen, who's number 3 here, and by the way, Steve Cohen is here. Steve Cohen is number 4 here. So he's been up there, dominant. He's number 3, and here we go. They were found guilty of insider trading. They paid a $1.2 billion fine and agreed to stop investing outsider money. And the name was changed to Point72. I think they did it to save the reputation. So top hedge fund managers are the highest paid pros in the world. And for example, in 2013, the top 25 hedge fund managers earned 18 times the average top 25 chief executive officer. So I got this information from Forbes articles and from the AFL-CIO. So questions and answers. Here we go. What's a hedge fund? It's a very versatile fund. Do they hedge? Yes and no. Some do, some don't. They're very good at it when they do. Are they criminal or meritorious? What did I say here? We'll explore that more in part 2. Mostly not very good. They did get rid of those huge spreads though that were on the New York Stock Exchange. So we have them to thank for that. However, their own trading outtrades the rest of us so much. They're the ones getting the money in massive amounts, more than ever, more than the people in the New York Stock Exchange ever made. Now they are making. Well, they were making. That's been fading. That's getting squeezed out. What do they produce? Nothing anymore. They used to bring bids and offers down. They used to bring spreads down. Now they do nothing. Okay? How much are their fees? They charge 2% on the whole portfolio, 30% of gains. We said that earlier. Are they really that successful? Some are. And some have been spectacularly successful. We'll get into that. Like one fund has a reputation run by Ray Dalio that it has not lost money maybe ever, called Medallion. And no one knows what that is because only the employees of that fund get to invest in Medallion. It's a fund that everyone gets to invest in. Let's see, where's Ray Dalio? Ray Dalio, he is at Bridgewater. So I think I might be wrong, but I think Dalio has Bridgewater, and they have. So who has the Medallion fund? Let's look at it. I'll go on the internet, see who runs the Medallion fund. See if I had that right. Oh, Peter Brown from Renaissance Technologies. Oh, good. I'm glad I looked. So Renaissance Technologies is... Are they in here anywhere? Let's see here. Are they in here? No. So Peter Brown, he might be in here though. Peter Brown, Renaissance. So he happened to not be in the top 25 that year. I'm looking Renaissance. Oh, James Simons and Peter Brown. Oh, they're both involved in Renaissance. So there it is, James Simons from Renaissance. There you go. That's what it is. Okay. So that's the Steve Cohen story. And that's the Renaissance story. They're the ones who have Medallion. And they've broken all kinds of records. All right, we know these people made a lot of money. Here we go. Now, so let's get to our answers. Here we go. We're at the end of the show. Shortest show maybe ever. What's a hedge fund? It's a very versatile fund. Oh, we went through these. Do they hedge? Yes and no. Are they meritorious? We'll explore that more. What do they produce? Nothing anymore. What do they charge? $220. Are they that successful? Some have been. Now we talked about that, Renaissance and the Medallion Fund. Are they a waste of talent? Now they are. What's their culture? Meta-aggressive. Hard to get a job there. Very hard. How much do they earn? Billions. They can earn billions. Should we bail out hedge funds if it helps? If it doesn't, absolutely not. But so long as it helps the whole economy, helps protect jobs, etc., yeah, we should bail them out. We should bail anything and anyone out that helps. Okay. All right. Should your child be a hedge fund manager? No, have your child. If they're that smart, they can be a hedge fund manager. Have them cure cancer, save the earth, or be president of the United States. Hedge funds part 2, we'll look at these things. How pools actually pay hedge fund high-frequency traders to trade. We'll learn about alternative ETFs versus hedge funds. We're going to look a lot more at numbers next time, but through charts. We're going to look at a lot of charts, and that's what I did not want to do today, was kill you with charts. But next week is going to be an assassination. It's going to be just a firing squad, and I'm going to wipe everybody out with charts. Hedge fund, we're going to look at hedge funds and dark pool innovators. There are some fascinating people in there, some of whom had the best intentions, and it's now turned out differently than they probably could have imagined. We're going to look at high-frequency trading and dark pool portion of the market. How much of the market do high-frequency traders have now, and how much of the market flows through dark pools, right? Do they control the world yet? They practically do. We're going to look at individual hedge fund strategies, which are really interesting, in fact. How much money have they made? I think maybe I said that earlier here. How socially responsible really are they? Let's look at that some more. What will hedge fund high-frequency traders do with quantum computing? What will happen when quantum computers come along? They won't really ever happen, by the way. Real quantum computers, I predict, won't really happen because they keep saying they do quantum calculations, but they haven't said they've made a computer because there are some serious problems, something called error correcting and other issues that I think will cause us to never have a quantum computer. We'll never achieve it, what we theoretically call a quantum computer. To me, I think there is one quantum computer in the universe, and that is the universe. That's what it is. It is a quantum computer. Okay. So I am, and you are, conscious beings, biological complex beings who are the result of in some sort of miraculous thing, not that a God created, because I don't think that's what it was, but something that I call miraculous because it is so improbable. The probabilities that it could happen are so outrageous that you can't measure them. It's infinitely impossible, but here we are. Okay. Anyway, and the future of artificial intelligence in general. Okay, that's what we're going to talk about now. Books. Look these books up. More Money Than God by Sebastian Mallaby. Dark Pools by Scott Peterson. The Big Short by Michael Lewis. Notice, you see how big Michael Lewis is as a writer? They has his name bigger than the name of the book. The Big Short. That's when you know you're a big writer. And then look, his name is nearly as big as the title of the book in Flash Crash. So these are four great books that I've read. I've written a screenplay. And it's all about this. It's about the abuse of some high-frequency trading. I created the story, and then I wrote the screenplay with Haley McLean. She is a professional, what's called script supervisor, who has worked on many famous feature films such as Star Trek. And she continues to work. She's worked on hundreds of combined movies and TV episodes and Netflix episodes and HBO episodes. Well known in the industry, knows any actor that we could name. On down. Has worked with them on a daily basis, right on the set, and directors as well, and producers. So here is the log line, it's called. Capital is about an idealistic investment banker, that was me, who battles high-frequency traders, and I never did that. I wish I had. I'm doing it now. Okay, and I just want to remind everybody, join the investment revolution. Open an online investment account. Look it up online or watch my older shows and learn how to do it. In 2019, it was the year of financial independence, just as 1776 was the year of the United States independence and other countries have their the year of independence. Literally, investors, everyday investors, are now independent as they never have been before, because you can open an online account with a top-notch broker, pay that broker nothing, no zero minimum balance and no fee, and you don't even pay them a commission if you buy stocks, because you're the one who goes in and pushes the buttons. And it's now so automated that it costs them virtually nothing to have you online, and they've all fought so hard for your business so they can have your cash, they can invest it. Because every time you open an account, you don't put everything in cash. Typically, you have a little bit of cash left in the account, and they use that to make their profits. And they have automated investment management, and you can trade on your desktop, laptop, tablet, or app, on your phone. They have evolving interfaces, and now you can high-speed trade. You can write algorithms, programs that do high-speed trading through these free online investment platforms. Incredible. So join the investment revolution. How do you like the flag? Isn't it cool? It's got those alpha signs in it. So that's it. That's the show today. I even literally think that I might have fallen asleep during this show, and I'm going to leave that in there because I'm tired today. So there it is. Let me get back into this and this. Here I go. I'm back with you. So thanks for hanging out. For those of you who've seen the show in the past, and if you've come back for more punishment and pain, thank you. Keep on coming back. If you watched my shows, and if you watch them especially, I recommend watching them more than once through. You would be investing hours of your time, but you would learn immensely from my shows. They are great. And you could go on and Google and follow up on stuff that I don't explain maybe so clearly in my shows, and you can learn it on your own, right? And you can always contact me at MorAlpha.net. Okay, you see that? Let me see. Let me point at it. There it is. MorAlpha.net. Okay, you can meet me there. That's my website. You can get a lot of more information there. You can get to older shows through there. Al Morrow from Carlsbad, California. Thanks for hanging out. Have a beautiful rest of your Monday.